Good morning, and thank you for joining us for today's webinar, U.S. Tax Reform, Taxation of Foreign Income and International Tax Matters. We will be getting started shortly, but first, I wanted to take a couple of minutes to go over the format of today's webinar. If you are attending this webinar for CPE credit, you must answer the 3 polling questions that are presented during the webinar, along with completing the post-webinar survey that will be sent out with the recording. All phones have been placed on mute for this webinar. If you have any questions throughout the webinar, please use the Questions tab in the menu. We will address questions at the end of the webinar as time permits. We will also be recording this session, and the recording will be sent out after the webinar. Again, thank you for joining us. At this point, I would like to introduce our presenters. Alan Osmolowski is a partner in our tax practice, and he focuses on providing tax consulting and compliance services to growing dynamic companies in a broad range of sectors, including technology, life sciences, real estate, manufacturing, and clean energy. Alan also serves as the firm's practice leader for Technology and Life Sciences Industry Group. Alan has over 26 years of experience assisting clients in identifying, evaluating, and implementing tax planning strategies that result in significant tax and cash flow savings. As a director in Bloom Shapiro's Litigation and Business Valuation Group, Andrew Bastian provides a complete range of valuation services to privately owned companies. Andrew's valuation experience includes valuations for gift and estate tax purposes, bank financing, litigation support, charitable contributions, equity-based compensation, equity buyouts, debt instruments, S-corporation elections, purchase price allocation, goodwill and intangible asset impairment testing, intellectual property valuations, and discounts for lack of marketability studies. With more than 15 years of experience, William Nchoko is an accomplished international tax professional with a proven track record of results, blending business, legal, public policy, and taxation expertise in advising multinational business organizations. As a tax director, William provides invaluable counsel for our clients operating in an environment of intense scrutiny and challenges brought about by the changing tax laws and ever-increasing regulatory environment. He has extensive expertise in international acquisitions, reorganizations, and global restructuring, as well as U.S. inbound and outbound tax issues. As a tax partner, Tony Swodajewski has over 30 years of experience in federal and state taxation and has specialized in multi-state taxation issues for the past 20 years. He is a partner in the firm's state and local tax consulting practice and tax advisory group, specializing in business, personal, and sales and use taxation for multinational enterprises, as well as for privately held businesses and their owners. Throughout his career, Tony has gained industry experience in manufacturing, distribution, retail, construction, biotechnology, software development, e-commerce, and financial services. I would now like to hand it over to Alan to begin today's presentation.
Terrific. Thanks, Jerry. Again, welcome everyone. Thank you for joining us today. As Jared mentioned, we're going to start with me just covering sort of the 4 key areas of international tax reform, which are really the change to a territorial tax system, the repatriation tax, which William will talk about in more detail later, the new GILTI tax. You got to love these acronyms we have now. We've got GILTI, and the other one is BEPS. So we're going to kind of cover those to start with. So, in terms of how we got here, this has been an issue that both parties were struggling with for some time. U.S. tax rates were higher than the rest of the world. Average rates for OECD countries around the world were at 24%, the U.S. was at 35%. And the regime the United States used to tax foreign income was a system of worldwide taxation. And that did allow companies to avoid paying U.S. tax on foreign income until they brought it into the U.S. There was a mechanism for deferral there. But ultimately, when a U.S.-based corporation paid a dividend back to the U.S. parent from a foreign sub, that dividend was taxed at U.S. rates, and they would get a credit for the foreign taxes paid. So whereas U.S. rates were as high as 35%, if you had a foreign earnings, low tax jurisdiction like Ireland, as an example, where you made it pay 12%, you had a very large disincentive to kind of bring that income back into the U.S. And so now the United States has changed to a territorial system, which is more in line with the rest of the world. We'll talk about some of the elements of the new territorial system the U.S. has we still retain some elements of the worldwide system, which is the GILTI tax. We'll talk about that. But currently now, there is a 100% dividends received deduction for foreign dividends received by a U.S. corporation. So that's a big change. So the example I gave earlier, you can now take that foreign earned income and repatriate that back to the U.S., pay a dividend to the parent entity, and not pay a second tax in the U.S. So it eliminates some of that disincentive to bring foreign earnings into the U.S. I think it's important to note this dividends received deduction that I mentioned applies to C corporations. It doesn't apply to S corporations. So, certainly a hot topic these days. There's a lot of discussion around, should my S corporation be a C corporation? If you're an S corporation with a lot of foreign activity, it's definitely something to think about. But it is something you have to sort of model out and look at based on your own individual facts and circumstances. So to get from a worldwide system of taxation to a territorial system, as part of tax reform, there's now a mandatory repatriation tax in place. And basically, any foreign earnings that were not subject to U.S. taxation previously are now subject to this mandatory repatriation tax. And this goes back to any foreign earnings and profits going back to 1986. Now, the rate on this is at a reduced rate. It's at 15.5% for the amount of foreign earnings and profits that are attributable to cash or other liquid assets. And then the remainder is taxed at 8%. So basically, any company's foreign earnings are now being subject to this mandatory tax. You do have the ability to use foreign tax credits to offset this. So to the extent that you had paid, tax in a higher tax rate jurisdiction, like France or Germany as an example, that could significantly reduce your overall rate on the repatriation tax down to, 2 or 3% in some cases. And as I mentioned, Williams will go into this in some more detail in a little bit. And then the question is, what are the states going to do in terms of this additional federal taxable income? And Tony's going to talk about that some more later. Next slide, please. And so in terms of the timing for the repatriation tax payment, taxpayers can elect up to an 8-year deferral, and it's graduated payments over that time period where the payments early on in that 8-year period are less than the payments towards the end of that deferral period. Now, what's interesting, most aspects of the tax reform bill all take place for 2018 prospectively. For a calendar year corporation, the repatriation tax is applied to its 2017 calendar year corporation return. So the first installment of this 8-year payment period of the repatriation tax can be owed as soon as April 15th with the filing of the 2017 tax return or extension. So there's a lot of taxpayers now that are doing a lot of work to compute what that tax is, having to analyze, foreign earnings and profits for over 30 years to compute this. So there's, quite a bit of work that needs to get done here to manage that compliance. And this is, one area. There's certain aspects of tax reform that have made some things simpler, but certainly in the realm of international tax, nothing's really gotten any simpler. Next, we'll move on to the Global Intangible Low Taxed Income, or GILTI. Interesting acronym that somebody in the Senate got creative to name this. And basically, GILTI is part of the system of carrots and sticks, I'll call them, to encourage companies to bring foreign earnings into the U.S., but then also invest in the U.S. in terms of future intangible property growth. And then the basic concept of GILTI is that a company would be subject to tax in the U.S. on a portion of its foreign earnings that are above a routine return amount. And this is sort of a concept that's already in place with the OECD and BEPS. That if you look at the tangible property of a company and apply a rate of 10%, which is the OECD approach. Anything above that is deemed to be earned from intangible assets. It could be earned from anything, but in this case, the assumption is that that is from an intangible asset. And then, so the amount above that is included as additional subpart F income for the U.S. parent company's U.S. income. The effect there is to apply sort of a minimum tax on foreign income. So you look at all your income from all foreign sources, look at what you have for tangible assets, multiply that times 10%. Anything above that is potentially subject to this GILTI tax. Also the mirror image of the GILTI tax is the foreign derived intangible income deduction. Similar approach on U.S. income generated from sales to foreign unaffiliated foreign customers. You would look at your tangible assets times this base 10% amount of return, and anything above that is eligible for a lower U.S. tax rate. We'll talk about that on a future slide. So next slide, please. So I mentioned, the GILTI is applied above its routine return amount over a 10% base, and then that's included in U.S. income's additional subpart F income. Next slide, please. There is a deduction. Excuse me, losing my voice today. There is a deduction allowed on the U.S. return for 50% of the GILTI inclusion amount. And then conversely, there's a deduction of 37.5% of revenue derived from foreign deemed intangible income. And this is kind of, a focus on trying to get closer to a 12% rate on foreign derived income. And so I think it's important to note also that there's foreign tax credits are available to offset any GILTI inclusion amount. And now you can use, foreign tax credits to offset 80% of the U.S. taxes. So in effect, if you look at where U.S. tax rates are at 21% now, and you take into consideration the 50% deduction for GILTI, that gets you to an effective 10.5% rate on GILTI income. And then if you look at the fact that you get an 80% inclusion of or you can offset 80% of your U.S. taxes, or I should say use 80% of your foreign taxes to offset U.S. income. If you're paying at least 13.125% on your foreign income, you take that times 80%, it gets you to 10.5%. You wouldn't have any additional tax owed in the U.S. So it's kind of a minimum tax approach that if you're at least paying 13.125% in foreign taxes, although you're subject to the GILTI inclusion, you'd be able to use the foreign credit to offset that. Similarly, if you have FDII, you are allowed a 37.5% deduction on the U.S. side. That gets your deduction down to effect 13.125% on foreign derived income from U.S. sources. That's sort of the carrot and stick approach, where GILTI is a carrot, the FDII is the the FDII is the carrot and the GILTI is the stick to encourage investment in the U.S. and bringing foreign earnings into the U.S. Those deductions change in 2025. The deduction for FDII changes to 21.875%, and the GILTI deduction is 37.5%. And so that, in effect, changes the minimum tax amount that we talked about to 16.4%. So again, if you're paying at least 16.4%, the ability to get the 80% deduction in the U.S. against that would allow you to offset any U.S. tax owed on GILTI income if you're paying at least that amount in foreign taxes. So again, FDII and GILTI only apply to C corps. They're not available for individuals or S corporations. So something to keep in mind as you're considering, options now for entity choice under tax reform. So I think I kind of talked about this already in terms of the effective rates. So we can go to the next slide, please. Again, just to bear in mind that the dividends received deduction and the GILTI deductions are not available to S corporations. So next slide, please. And then the last thing I wanted to talk about was the base erosion anti-avoidance tax, or the BEAT. And this is a tax that applies only to companies with gross receipts over 500 million. This does not apply to S corporations. And in general, the BEAT is geared towards applying an additional tax, sort of a minimum tax that's applied on a U.S. company that has payments to foreign affiliates that are reducing its U.S. tax. And so, the way this is applied is you would compute your U.S. taxable income, excluding any payments that are paid to foreign affiliates, and then apply a 5% rate on that, and then compare that result to what the corporation is currently paying for U.S. taxes, and pay the higher of the two. So it's essentially a minimum tax being imposed on U.S. companies that are making payments to foreign affiliates. And that increases to 12.5% in 2026. And I think a lot of companies that are making payments to foreign affiliates that have complicated supply chain issues, et cetera, really got to take a look at that. But again, it only applies to companies that have gross receipts over 500 million. So what does all this mean for my business? You look at, for financial reporting under U.S. GAAP, ASC 740 requires that companies report the effect of a change in tax law or rate in the period it was enacted. So since the president signed this into law in December, companies have to readjust their deferred tax assets and liabilities, and from a financial reporting standpoint, address those changes effective in Q4 of 2017. Definitely a need for doing a lot of modeling and projections to analyze, whether it makes sense to be a C Corp now versus an S corporation. I can say from the work we've been doing with our clients, for the most part, most of our clients that are currently S corporations are probably better staying as an S corporation, but that's something we're continuing to look at and monitor. The repatriation tax, the first payment for that is potentially due in April of this year, so there's a need to do a lot of those E&P studies going back potentially for 30 years of foreign earnings. So a lot going on right there now, and again, we're going to talk some more later about the state tax implications of the federal changes. And that covers it for my part of the presentation, and now we've got our first polling question.
As a reminder, if you are attending this webinar for CPE credit, you will need to answer all 3 polling questions, beginning with this one.
So it is an interesting question. I think the answer is going to be really, only time will tell, but so far it seems a lot of the changes have been received very positively from a business perspective.
We're going to give it about another 10 to 15 seconds. If you haven't gotten your polling answer in, please do so now. Great, thank you to all who voted.
So for transfer pricing, just want to introduce that concept. Is a transfer price is the price charged for goods, services, or intangibles that are sold or transferred between related legal entities within a multinational enterprise. And there are regulations in place, not just here in the United States, but throughout the globe, that require that a transfer price amongst related parties be arm's length, meaning that the transfer price must be consistent with the price that would have been charged to an unrelated party. I first wanted to discuss something before getting into the tax reform is to briefly talk about this base erosion and profit shifting, or more commonly known as BEPS, which is a 15-point action plan put in place by and launched by the OECD and G20 countries. And the reason why I wanted to talk about that as an intro is much of what's in the BEPS program is the genesis of the international tax reform in the United States. But also, just as important is, as much as there's been a lot of changes from an international tax perspective here in the United States, BEPS has also changed what other countries are doing throughout the globe. So it's important that when we talk about strategies and what you can do to react to the GILTI and the BEAT and the FDII is also take into account what's going on globally through this BEPS action plan. We go to the next slide. So in terms of the BEPS action items that relate to transfer pricing, such action plans were released in 2015, and late last year in 2017, the transfer pricing guidelines that many of the tax authorities throughout the globe rely upon was updated in 2017. And what one of the action plans did was what are the recommendations and guidelines for what tax authorities should require from a transfer pricing documentation perspective. So here in the United States, we've always had a documentation requirement that required you to prepare your transfer pricing documentation on an annual basis for any of your intercompany transactions. But from a global perspective, OECD is recommending that there be a master file, a local file, and a country-by-country file. From the perspective of the United States, we've always had that documentation, but we're now requiring that there be a country-by-country report prepared and filed with the IRS for companies with an average annual revenue of $850 million a year. If we can go to the next slide. Also very important is, in addition to the documentation requirements from a transfer pricing perspective, there were new guidelines introduced for something called DEMPI. It's maybe not as catchy as the GILTI and the BEAT that Alan was talking about in terms of the sounding of the acronym. But what that stands for is development, enhancement, maintenance, protection, and exploitation of intangibles. And if the legal owner of IP is not performing or managing any of the DEMPI functions, but a related party is, then that related party must be compensated for their contribution. So essentially what that means is you can't just sell your intellectual property to Ireland or another holding company where there might be a lower tax rate and not expect there to, and not have any labor force there. Legal ownership is a fact that must be recognized, but it does not necessarily tell us anything about what the appropriate remuneration to the parties that contribute value should be. And what this guideline from the BEPS program is DEMPI is a qualitative tool to help assist the functional analysis and determine what that compensation should be. No longer can a multinational company say that legal ownership of IP trumps everything. It needs to be more than that. This is not really a revolutionary concept if you've been doing transfer pricing the right way. It's particularly from the tax authority here, the IRS perspective, is how transfer pricing should have always been done. But because we've had a lot of base erosion throughout the globe, this action plan is really kind of putting an acronym behind it and some structure behind how transfer pricing should be documented from an IP perspective. So while it's true that the BEPS guidelines have created more monitoring and compliance issues throughout the globe, it should also be viewed as an opportunity for multinational companies to review their transfer pricing on a country-by-country basis and clean up any inconsistencies. It also provides an opportunity to look at past planning and what has worked and what has not worked, and use BEPS and the tax reform as an opportunity to change strategies, some of which I will address in the next slide. But the first thing that's important to discuss is the anti-inversion provisions that is part of the tax reform. If you're planning on inverting your multinational entity and become an expatriate within the next 10 years, the tax reform bill enacts some anti-inversion provisions. And first, it enacted a participation exemption, which through new Section 245A allows 100% dividends received deduction for foreign source dividends received by most domestic C corporations from 10% or greater foreign subsidiaries. And if you invert within the next 10 years of this bill, you'll be denied that participation exemption, and the taxpayer's mandatory inclusion would be subject to a 35% tax rate and not the more favorable 21% tax rate. And the taxpayer would not be able to utilize foreign trade corporations to offset U.S. federal tax. So that's something to keep in mind. And now for GILTI and FDII, these provisions don't directly impact transfer pricing rules or regulations. However, they do impact the incentives for multinationals to allocate income through transfer pricing to the U.S. consolidated group. And as Alan had mentioned, GILTI is the stick in that provides some disincentives for U.S. multinationals to attribute intangibles related income to CFCs in low tax jurisdictions. And FDII is the carrot that incentivizes U.S. multinationals and subsidiaries of foreign multinationals to attribute intangibles related to income to the U.S.
If I could just jump in for 1 second, one thing I meant to mention earlier that I neglected to mention was that there's already some countries in the EU that are challenging FDII and saying that it violates OECD principles without allowing a reduced tax rate on exports. Whether or not that will be around for a long time is yet to be determined.
Yeah. So determining a U.S. multinational's liability for GILTI tax and the ability to benefit from the FDII deduction under existing structures, it's complex, and restructuring to minimize GILTI and maximize FDII needs to be analyzed on a case-by-case basis. And that's all more important to what Alan had just mentioned in the BEPS program is we need to pay attention to what other countries are doing as well in terms of how that all folds into the strategy. And for instance, a strategy for the GILTI tax liability is you can offset the potential GILTI income of high margin, non-capital intensive activities of a controlled foreign corporation, such as an IP holding company. You can offset it with routine returns of tangible, depreciable business assets held by other more capital intensive CFCs, such as manufacturing and operating companies. And the GILTI tax applies only to U.S. parented multinationals. But in contrast, the FDII deduction is available to all domestic corporations, including presumably U.S. subsidiaries of foreign parented multinationals. Thus, in some cases, it may be advantageous, and here's a strategy to think of, it may be advantageous for foreign parented multinationals to consider expanding their U.S. operations, their U.S. subsidiaries, and what they do to include direct and indirect sales, including license or leases or licenses for ultimate consumption in the non-U.S. markets. So that's kind of the FDII is a way of encouraging more activity here in the United States. And the next slide, please. So while we're talking about carrots and sticks, the beet is a stick. I would call it maybe the beat down stick because it's trying to beat down base erosion. And the base erosion payments would include what's listed here as interest, royalty, and services. But it's important to know that it does not include cost of goods sold or certain qualified derivative payments, payments subject to withholding tax, or payments for services that are provided at cost. Oftentimes, multinational companies do cross charges for certain services and charge at a cost plus. But if you're paying for certain services at cost, it's not included in the BEAT tax. We can go to the next slide. So as a result of BEAT, multinationals may wish to revisit their transfer pricing policies for transactions involving payments from domestic corporations to foreign related parties. For example, you may want to look at reducing royalty or interest payments that may trigger BEAT. If the transfer pricing were changed to reduce the royalty and interest payments, this may eliminate BEAT liability by either reducing the subsidiary's base erosion percentage and or reducing the amount of the BEAT add-on below the corporation's regular tax liability. However, again, looking at it from a global perspective, you still need to make sure that those royalty and interest payments are arm's length. So this is where documentation comes in handy again, because we have to look at it from what other countries would do. If you change any royalty or interest payments, you have to make sure that they're arm's length. Otherwise, a foreign jurisdiction may take issue with your change in transfer pricing. Another thing you can do in a strategy is to take advantage of the COGS exception. And I'll give an example is consider a U.S. subsidiary that licenses intellectual property from its foreign parent, then engages a related contract manufacturer to manufacture products using that same IP. In that case, the royalties paid to the foreign parent are subject to BEAT. But you can change the strategy, and instead of licensing its IP, the foreign parent can engage the foreign related contract manufacturer directly instead of the U.S. party doing it. And the U.S. subsidiary can purchase the manufactured products for resale directly from the contract manufacturer. So that all ends up in COGS. No BEAT would be incurred because the purchases would be included in the COGS. The multinational may also be able to manage the BEAT by having domestic operations with the group transaction with third parties rather than foreign related parties wherever feasible. So think about it. If you're paying interest on a loan to a related party, you may want to look into paying that interest to a third party bank instead, because that interest payment to a related party would be subject to the BEAT. And then lastly, we would want to take a look at the services that are being cross-charged. So again, it's common for multinational entities to cross-charge for services such as management, IT, human resources, and oftentimes a payment would be made not just at cost, but at a cost plus. When it's at cost plus, that ends up being subject to the BEAT. But if it were charged at cost and you were paying just for the basic salaries for management or HR or IT, then you would not be subject to the BEAT. The idea is that you're not sending as much money overseas otherwise. So if we could go to the next slide, and I'll talk about what the changes are for intangible property transfers. For a long time, transfer pricing strategy in many of my studies have been related to transferring IP offshore and what the value of that IP is. And typically that IP has been trademarks or customer lists or patents. Well, the Tax Act includes an expanded definition of what's included in intangible property, and that includes workforce in place, goodwill, and going concern value. That's something to keep in mind if you're ever transferring such intangibles offshore. So if we go to the next slide. So this last slide will discuss, or actually second to last slide, it will talk about what's the approach from a transfer pricing perspective post-tax reform. Well, we can consider restructuring. You can consider locating your IP in the United States. We've already talked about GILTI, FDII, and BEAT. All of those carrots and sticks approaches are really encouraging the IP to remain here in the United States rather than move it offshore. Also, you need to think more about it from a transfer pricing documentation perspective. It's really important to make sure that if you do any restructuring or changing of cost plus arrangements or where you locate your IP, there's a lack of key guidance out there, and taxpayers are taking positions based on interpretations of the Tax Act, but they should document the facts and rationale for their position up front and be prepared to defend their position, not only here in the United States, but globally. And if we can go to the next slide, I also wanted to make everyone aware, much of the focus is on tax reform, but also January 12th of this year, the IRS has released a directive to its examiners that you're supposed to be preparing your transfer pricing documentation on an annual basis, and not every multinational does. And the IRS may actually impose a penalty on a multinational enterprise operating in the U.S. If a transfer pricing adjustment eclipses $10,000. And those penalties can range from 20% to 40% of the underpayment of tax. However, a taxpayer can avoid such penalties by having adequate transfer pricing documentation and providing it to the IRS within 30 days. This directive reminds examiners that simply having a study is not sufficient, but the study should meet the parameters of Section 6662 and its regulations. It's not just a reminder to IRS examiners, but also serves as a reminder to multinational companies of the importance of having transfer pricing documentation on an annual basis. So I just want to let everyone know that this is very much on the front lines of what the IRS is doing and requiring that when they audit a multinational company, that they're asking for the transfer pricing documentation and that it meets the strictures of the regulations. Thank you for listening.
We're now on to the second poll question. As a reminder, if you're attending this webinar for CPE credit, you must answer all three poll questions. We'll give it about another 15 or 20 seconds if you have not gotten your poll answer in. Thank you all. I'll now hand it over to William.
Thank you very much, and good morning, everyone. My name is William Choco, and I will talk a little bit more about the transition tax or repatriation tax. Alan has laid out some introduction about this new tax, and I will discuss a little bit more about this transition tax. So let's go to the framework of this new tax. This tax applies to U.S. shareholders of deferred foreign income corporations for tax year 2017. This tax is mandatory and one-time tax, as Alan mentioned, and the effect of this is it is a deemed repatriation. Foreign corporations does not have to bring that money back physically in the United States. It doesn't have to be deposited in a bank here in the United States. So the effect is deemed repatriation. It is mandatory. It applies to everyone. It applies to corporations. It applies to individuals as well. So the tax rates provided by the statute are bifurcated. You have 15.5% for cash and cash equivalents, and you also have 8% for non-cash. You have to note that these rates, the 15.5, is an effective tax rate, 15.5 and 8%. So many people would ask, do I need to apply 15.5 straight to my cash portion of my E&P and 8%? no, that's not the way to do it. Well, we'll look at that a little bit more when we get to the examples. There's a determination date here, which is the greater of. So as I said, this transition tax is determined whatever amount is greater between the November 2nd, 2017 amount or December 31st, 2017 amount. As Alan mentioned, this transition tax is, as the name suggests, transitions to this new participation exemption concept of taxation for dividends earned in foreign jurisdiction. So after 12/31/2017, any cash or any dividends repatriated from a foreign corporation back to the United States will no longer be taxed under the new participation exemption provision. So to transition to this new concept of taxing foreign earned income, we have this one-time tax. So there is an election to pay the tax over 8 years, and I believe the first 5 years there's a tax rate of 8%, and then you have the next 15, and then 20 and 25. So there was an election to pay this to mitigate the impact of this new tax. And again, as I said, it applies to individuals and as well as corporations. There's a special rule that applies to S corporation to defer tax liability, and what that means is that for S corporations, the rule mandates that the S corp computes or determines the transition tax this year for taxable year taxpayer 2017, and inform the shareholders of their transition tax liability. However, there is this deferral that the statute says that the shareholders of an S corporation can actually defer that until a triggering event occurs. And the triggering event is basically a disposition of the interest in the S corporation. Until such time happens, and when such time happens, the shareholder can still do the election of 8 years. So you will notice that there is a rather lengthy deferral to pay this liability with regard to S corporation, which, by the way, this particular benefit is not applicable to individual. We will see if there will be further notice or pronouncement from the Treasury and the IRS on this. But right now, the deferral only applies to S corporation. And as I said, the transition tax applies to for 2017 tax year, so 12/31 taxpayers calendar year, they have to include this in their tax return for their filing this year. The way the transition tax is determined, the Congress applied the participation exemption concept in determining the transition tax. So what that means, as I said, the 15.5% for cash and the remaining 8% for others is an ETR. This is the effective tax rate after applying the DRD, which is a concept borrowed from the participation exemption concept. So again, for calendar year taxpayers, the rate of deduction is 55.7 and 77.1 for CAT, and we'll see that in our example shortly. There are a lot of new definitions. There are new terms of art here in this new tax, but I would like to just mention these two terms. The DFIC, we call it the Deferred Foreign Income Corporation, and the Specified Foreign Corporation. So what is a DFIC? DFIC is any specified foreign corporation, or SFC, of a United States shareholder which has accumulated post-1986 deferred foreign income greater than 0 as of the measurement date. And SFC is a very important concept as well. SFC is any controlled foreign corporation, any foreign corporation with at least one domestic corporation that is a U.S. shareholder. And there's an exception for PFICs that are not CFCs. But you will note that if a PFIC is a CFC, then this rule would cover that particular PFIC, because under the rules, CFC trumps the PFIC rules. Let's look at some example here. So these are some examples. These are some illustration where, you know, the transition tax applies. So first, we have here a non-CFC. So it's not a controlled, it's a foreign corporation. It's not controlled by a U.S. shareholder. So that's why we say it's a non-CFC. It's a U.S. individual that has 10% interest on it, and the 90% is owned by a foreign corporation. So question is whether or not this is the non-CFC is a specified foreign corporation. The answer is no. This situation is not covered by the transition tax. Next is we have again a non-CFC, a foreign corporation, with a U.S. corporation that owns 10% of it, and a foreign corporation that owns 90%. Question is this a SFC? It is, because we have here a U.S. corporation owning 10% of the interest in the non-CFC. So again, you know, 10% is the benchmark ownership percentage for a person to be considered as a U.S. shareholder. The third one, we have a PFIC here. We have a U.S. corporation that owns 10%, and another foreign corporation that owns 90% of it. Question, is this an SFC? No, because this is a PFIC, and here we assume that the PFIC is not a CFC. And the last one, we have a CFC here, controlled foreign corporation. We have U.S. individuals here. Question, is this an SFC situation? Yes, it is, because now we have a CFC, and as we can see from the definition, specified foreign corporation is any CFC, and that here, the last example shows that it is a CFC with U.S. shareholders, individual U.S. shareholders. So now let's look at some example on how we compute the transition tax. In this slide, we have here a U.S. parent with two controlled foreign corporations, CFC1 and CFC2. CFC1 and CFC2 are both SFC under the new rules. CFC1 has post-86 accumulated E&P of 1,100 and a tax paid abroad of 50. CFC2 has post-86 E&P of 750 and a tax of 50 as well. Note that at the heart of the transition tax calculation is the concept of earnings and profits. E&P is a term of art that is really not defined in the code, but you can see its definition in the regs and other pronouncements by the Treasury and the IRS. The next step is to determine which E&P amount is greater. The average of the E&P determined at 12/31/2015 and 12/31/2016, or the amount determined as of 12/31/2017. In our example, the amount of 12/31/2017 is greater than the average of the 2015 and 16 amounts, so that the 2017 amount will be taken into consideration in determining the transition tax. Note that on example, the E&P is bifurcated between cash and non-cash. The bifurcation is required because the new law provides for a specific rate for cash, as we saw, and another rate for non-cash. In our example, the cash is 1,200 and the non-cash portion is 650. So let's look at the computation here. This slide shows two columns, the cash and the non-cash columns. We know that our cash E&P is 1,200 and our non-cash E&P is 650. Next, we need to determine what is the taxable deferred foreign income or taxable E&P. To determine the taxable DFI or taxable E&P, we need to deduct the amount that is allowed to be deducted from the gross DFI or gross E&P. The allowable deduction percentage is 55, as I mentioned earlier, 55.7 for cash and 77.1 for non-cash. These percentages are arrived at by tax affecting 15.5 for cash and 8% for non-cash, which are provided by the new statute, by 35%, which is the statutory rate at 12/31/2017. You can see how the formula on top of the screen here. Let's look at the cash column. The allowable deduction is 668, and deducting this amount from 1,200, the taxable DFI or E&P is 531.6. The next step is to add the so-called Section 78 gross-up amount. Note that the transition tax allows a tax credit for the foreign taxes paid on the E&P for corporations, but only to the extent of the taxable E&P. In other words, the foreign tax credit is allowed, but only in proportion to the E&P that is being taxed. Thus, in our example here, the allowable foreign tax credit is 44.3, as we have 100 of total tax foreign tax credit in our tax pool, which is 44.3% of the total tax pool of 100 as shown in the prior slide. That's the 100 there on the top, the tax pool of 100. Now, under the rules, the foreign tax credit must be included in determining the taxable income, and technically this is called the Section 78 gross-up amount. So the Section 78 gross-up amount of 44.3 is added to the taxable DFI to arrive at the total taxable amount. In the example, the total DFI is 575.9, which is 531.6 plus 44.3. 575.9 is then multiplied by the statutory rate of 35, the rate effective as of 12/31/2017. The U.S. tax is 201.57. The U.S. tax of 201.57 is offset or reduced dollar for dollar by the foreign tax credit of 44.3. Thus, the net U.S. tax for the residual U.S. tax is only 157.27. The same process applies to the non-cash column. If you do the math, you will arrive at the same thing. Now, you will note that if you're going to divide that 531, if you're going to divide the 575.9 divided by 1,200, you will arrive at that 15.5% effective tax rate. Now, that's how you arrive at that 15.5. For non-cash as well, if you do 171.71 divided by 650, you will arrive at that effective tax rate of 8% for non-cash portion of D&P. Again, this is an example applicable for corporation. The effective tax rate for individuals, if you do the computation, will be slightly different. It will be about 17% for individual for cash and about 9% for the non-cash portion. The calculation process is the same, but the rate is slightly different. Thank you very much.
Thank you, William. My name is Tony Swit. I am a tax partner in the West Hartford office here at Bloom Shapiro. And we only have a few minutes left, but I think a discussion of tax reform wouldn't be complete without some awareness of how tax reform will impact state income taxes. Obviously, tax reform will have an impact on your state income tax liabilities because, for the most part, individuals and corporations begin with federal taxable income. And as federal taxable income is changing, so is potentially state income. But the key determination that the states are now grappling with is how their tax code is tied to the Federal Internal Revenue Code, and I'll discuss that next. What we're seeing now is that state legislators and tax departments are becoming active to address the tax reform. And what we're seeing is that some states have a more formal process than others, meaning that they need to look at how it's going to impact their budgets, bring it to their legislators so that the legislators could formally act upon how certain key things in the tax reform is going to affect their budgets. So we're probably not going to see some reactionary legislation potentially until late 2018 or early 2019. Some states have issued sort of preliminary reports. California and New York are examples that kind of look at each of the provisions of tax reform, make an analysis of how it's going to affect their tax code and potentially their budget. But we're really at the very, very early stages when it comes to how this is going to affect state income taxes. The key thing I said was how a state tax code is tied to the Internal Revenue Code. One thing that's consistent in state taxes is that no states are consistent. It's a very inconsistent tax regime. We have basically 52 jurisdictions, if you count New York City and the District of Columbia, that have their own specific tax codes. And they generally look at their tax codes in three buckets. Rolling conformity means that those states tied to their Internal Revenue Code as currently enacted. So Connecticut is an example. Whatever has happened for the Tax Reform Act has happened in Connecticut. So Connecticut would have to look at their code to see if they want to accept the tax reform provisions or decouple from them. Fixed date conformity states, there's about 19 out there that tie their code to a specific date. Texas is an example, 2007. So they're 10 years behind our Internal Revenue Code right now of 2017. So presumably all of these tax reform measures wouldn't affect Texas as far as their margin tax goes. They would have to pass specific legislation to bring in these Tax Reform Act items or adopt the code as of 2017. Then there's a handful of states out there that have selective conformity. California is probably the biggest one. They pick and choose which parts of the code. They generally follow the code, but they pick and choose which parts of the code they would want to enforce. So essentially they have their own tax code. So some of the key things we kind of talked about that you would have to be aware of when it comes to state taxes are, I listed them here. We didn't talk about the interest expense limitation, but if you attended the corporate webinar, you might have heard about that. It's a 30% limit based on basically your tax EBITDA, and Section 163J has been substantially revised. In the past, that used to mainly apply to companies who were thinly capitalized, a debt-to-equity ratio of 1.5 or higher. Their interest expense may be limited if they were paying interest to a foreign-related entity. That has all gone away. There's simply a 30% limitation now, and as a result, more companies may be trapped in this limitation, and as a result, state taxable income could be affected. The deemed repatriation provision is only a 2017 provision. So for those states that haven't adopted the code of 2017, they would have to retroactively go back and bring that income into their taxable base. We talked about foreign dividends under 245A. They're eligible for 100% DRD. Not so fast when it comes to state income taxes. Generally, the states will treat foreign dividends similarly to how they treat dividends from domestic corporations. And an interesting twist is some states will disallow expenses related to those dividends. For example, the governor has proposed legislation that if you receive a foreign dividend, you'll receive 100% DRD, but it's deemed as though 10% of that foreign dividend are related expenses attributable to generating that dividend. So you have to add back 10%. So in effect, you will have some taxable income there. Alan talked about the foreign derived intangible income, which is could potentially create additional taxable income because you're bringing your IP over into the U.S. So again, your state tax liability might go up. Your GILTI inclusion, again, that's something you have to be aware of. That's sort of an unexpected windfall for the states. They were kind of caught off guard on that. So they're grappling with whether or not they're going to tax companies on that. IC DISC survive. There's some talk about them being repealed, but they survive, and they're mainly beneficial for in the S corporation context that have export sales. And to wrap it all up, if you're in a multinational group, you might be filing a unitary report, whether it's on Water's Edge, worldwide, or an affiliated election. These provisions somehow will dovetail into how you are reporting your combined group. So you have to kind of consider that as well. So as you can see, federal laws are very complex, but when you layer on, you can't stop there. You have to layer on the soft aspects to understand how it's going to affect your state income tax liability.
It's now time for our last poll question. Again, if you are doing this for CPE, you must answer this third and final question. And it does look like we just hit a little past noon. So we did see a few questions come in. We will take the time to follow up with those who did ask questions following the webinar. So we will get to those questions. We'll give about 10 more seconds on this poll question, and then we'll wrap up. Okay, so thank you for attending today's webinar. We've got information up here for the last webinar in our tax reform webinar series. Again, if you did ask any questions during this webinar, since we are a bit over time, we will follow up with you after this webinar. If you have any last-minute questions you'd like answered, feel free to submit them now, and they will still get registered. So thank you for attending today's webinar, and we'll see you on another one soon. Thank you.